Most people think trading is about predicting the market, finding the perfect indicator, or catching the next big move. But that belief is exactly why most traders lose. Because trading isn't about prediction at all, it's just risk management in disguise. The market doesn't reward people who are right. It rewards people who survive. You can be right multiple times in a row and still destroy your entire account with one oversized trade if risk isn't controlled. Which is why professional traders never start by asking how much they can make, but instead ask how much they are willing to lose if they are wrong, because they understand that losses are unavoidable. Every single trade exists in uncertainty. No setup, strategy, indicator, news, or expert opinion can guarantee profit. The moment you enter a trade, you step into probability rather than certainty. And in a probabilistic environment, survival is more important than confidence, intelligence, or excitement. Most beginners do the opposite by risking too much on one idea, chasing quick profits, increasing position sizes after a few wins, ignoring position sizing rules, or moving stop losses because they feel the market will turn. And these behaviors are not strategy problems, but pure risk management failures that the market punishes without mercy. Successful traders think like business owners, not gamblers. They never put all their capital into one idea. They spread risk, plan for drawdowns, and build systems that protect them from emotional decisions. They accept small losses as a normal cost of doing business rather than personal failure. They define risk before entering a trade and exit the moment that risk is hit without hesitation, emotion, or excuses, because uncontrolled risk creates fear, panic, revenge trading, overtrading, and impulsive decisions, while controlled risk creates clarity, patience, discipline, and consistency. This is why two traders using the exact same strategy, charts, and indicators can have completely different outcomes over time. Not because one is smarter or luckier, but because one protects capital while the other exposes it. The market itself is unpredictable and doesn't care about your opinions, confidence, effort, or hopes. You cannot control price movement, breaking news, sudden volatility, or market sentiment. The only thing you truly control is position size and how much damage a single trade can do to your account. And, ironically, the moment you stop focusing on profits and start focusing on protection, profits begin to appear naturally. Because capital that survives has the opportunity to compound, while capital that is destroyed has no second chance. Trading success is not about winning every trade, avoiding losses, or being right all the time. It's about staying in the game long enough for your edge to play out over dozens and hundreds of trades, which is why patience beats intelligence, discipline beats prediction, and risk control beats excitement. At its core, trading is not about forecasting the future or proving yourself right. It's about managing uncertainty, protecting capital, and staying emotionally stable. And once you truly understand that trading is simply risk management in disguise, everything about the market losses, wins, drawdowns, and long-term success finally starts to make sense.